Mr. Cambridge, question and suggested solution. This is video tutorial number 3 out of 3 dealing with the Mr. Cambridge question and solution. In this video tutorial, we are going to look at the statement of financial position. Just to review, we discussed the trial balance earlier and we discussed all the items that are in the trial balance. And we have discussed the notes, how these notes will be brought into the solution. We have completed the statement of the income statement, and we are now going to look at the statement of financial position. The statement of financial position is a listing of all the assets, the capital and the liabilities on the 30th of June. So we'll have a quick look at that now. So we need to set up our statement of financial position as at or as on the 30th of June. We're going to start off with our non-current assets, and the non-current assets are always presented in a table. In the table you'll have the original cost of the asset, the depreciation to date, and the net book value. So there we have 3 columns there: the cost, depreciation, and the net book value. And then under the non-current assets here, we'll list the assets. So we have premises, equipment, fixtures and fittings, and motor vehicles. So these non-current assets are the assets we buy and we keep and we use in the business. A business also has current assets, and in this case the current assets are the inventory, the accounts receivable, prepayments, and bank. When we put all those figures in, we'll add them all up and we'll get the total assets. But first of all, we're going to start up here with the non-current assets. If we go back and look at the question, we can see we have the first one, premises at cost here, and under the provision for depreciation we have no entry for premises. The provision for depreciation figures here represent the depreciation on the asset from the day it was bought up to the beginning of the current year. If we have a look at the notes, we can see a note number 2 there, where we look at the depreciation instructions with equipment, fixtures and fittings, and motor vehicles, no mention of the premises. The assumption, therefore, is that Mr. Cambridge is not depreciating his premises. In other words, the premises are not wearing out. So we'll put in the original cost, we'll put in the depreciation at nil, and then we'll put in the net book value, which will be the cost minus the depreciation of nil, so the net book value and cost will be the same. So there are those figures there. The next thing is the equipment. So let's have a look now at the question again. We can see we've equipment at cost 64,000, so we're going to pop that in. So what I'll just do for the moment, I'll just write this in here, 64,000. Now the issue is I have to work out this figure here. Now I'm just going to write some workings in here, but I'll have to remove it in a few seconds because it'll be in the way of my current assets. But to get the depreciation figure, I need to look in the trial balance and I need to look in the income statement. If I go to my trial balance now, the equipment, we can see the provision for depreciation of 13,000 is the depreciation from the day the asset was bought up to the beginning of the current year. So I have 13,000 going in there. Now, in the income statement, we've worked out the depreciation for this current year. So if I go back and have a look at that, I can see the depreciation on the equipment for this year is 6,400. So the depreciation in the balance, in the statement of financial position, is rolling forward with the depreciation from the previous years, and then it's added to the depreciation for the current year, 6,400, which gives 19,400. Now that's the figure that goes in there, 19,400. So I'm going to have my cost minus my depreciation equals my net book value, which will be 44,600. Now you don't actually have to put in the minus and equal sign, but that is effectively what you're doing. Now I'm just going to remove my handwritten notes from this and pop in the figures. So 64,000 cost, the depreciation on the equipment up to and including the end of this year, in other words the 30th of June, is 19,400, so the net book value is 44,600. Now the fixtures and fittings are calculated the same way. I will go to the trial balance and I get the asset at cost, 15,000. I get the accumulated depreciation of that asset, in other words, depreciation up to the beginning of this year, which is 5,400. I will then go to my income statement and I get the depreciation for this current year, 750, which gives me the total depreciation of 6,150, which I will pop in here. So I'll have the original cost, the depreciation, and I take the depreciation away from the cost to get a net book value of 8,850. And for the motor vehicles, it's the same process. The motor vehicles at cost, you can see there, 18,000. The depreciation of the motor vehicles up to the beginning of this year, 6,800. The depreciation for this year, 3,600. So I'm adding the 3,600 to, let's go back and check, the 6,800, and what I therefore get is motor vehicles of 18,000, depreciation to date, up to including the 30th of June, 10,400, so I get a net book value of the motor vehicles of 7,600. Now what I'm going to do, I'm going to add up each one of these columns, one by one, and put in the totals. So I have the total cost of all my assets, 147,000. The total depreciation of all my assets, 35,950. And the net book value, 111,050. You will note I've underlined the cost column and I've underlined the depreciation column because it's the net book value figure that I'm going to continue with. Now I'll pop in the rest of my assets, my current assets, and what I'll do is I will add them up in this column here, and then when I have them all done, I'll bring the total out and line it up underneath the net book value of my non-current assets. The inventory figure, well, let's just have a quick look at that. It's the closing inventory, so it's the figure from the additional information. So I'll pop that in there. The accounts receivable, well, that's straight from the trial balance. So I'll pop that in there. The prepayments, now if we just go back to the notes, insurance prepaid of 1,000. So I'll pop that in there. And the bank figure, well, that's straight from the trial balance. So what I'll do is I will add those up, I'll bring them out and line them up underneath the net book value of my non-current assets. So that comes to 100,500 is the total of my current assets. So my total asset figure comes to 211,550. We are now going to look at the other part of the statement of financial position, which will be the capital and the liabilities. We have a total asset figure of 211,550, and remember, total assets must equal to capital and liabilities. So looking at our capital part, first of all, we have the capital, and we'll take the balance at the start of the year. Now that's coming from our trial balance, and it's the 100,000 figure. So I will pop that in, and then I'm going to add on to that my net profit, which is the figure that we calculated in the income statement. I will take away from that the drawings, which is the money that Mr. Cambridge took out of the business for his own personal use, and that'll give me the capital balance at the end of the year. I will then list my liabilities. I'll have my current liabilities, which will be the accounts payable and the accruals. In this particular question, there are no long-term liabilities. So in other words, we won't have a little heading for non-current liabilities. There are no long-term loans. So therefore, when we have all those in, we get the total of capital and liabilities. So back up here, I'm going to look at the capital at the start of the year, which I've already mentioned is 100,000. I'm going to add in my net profit figure. So let me just have a look at that. There's the net profit figure that we calculated in the income statement, 88,550. So I'll pop that in, add them together, and then we'll take away from that the money that Mr. Cambridge took out for his own personal use. Now, that's in the trial balance. In fact, it's the very last item in the trial balance. It's the 8,300. So I'll pop that in. So that will give us a total of 180,250, which is Mr. Cambridge's capital at the end of the year. So finally now we're just going to pop in the liabilities. And as I've mentioned, there's no non-current liabilities. In other words, there's no long-term loans. We have the accounts payable from the trial balance, and we have the expenses accrued from the notes. So we just have a quick look at the notes here. We can see the accrual for light and heat, 500. So that will be our expenses accrued. So pop that in there. Add those two together and line them up here underneath the capital. So what I'm going to get now is a total of my capital and my liabilities, which comes to 211,550. Now, just checking. Total assets, we can see here, come to 211,550, and total liabilities come to 211,550, and they always have to. If they don't balance, you've made a mistake. Okay, that's the tutorial completed. Thank you very much.